Welcome to Part 9 of Auditing Standards number 5. AS5 has over 100 pages, which is really heavy reading for most of us. So I'm going to make it easy to understand by talking through the key concepts and not reading specific items to you. This section is the relationship of risk to evidence to be obtained. This training gives context to SOX 404 requirements. It's meant to be an easy breakdown of dense words. So the table of contents here came directly out of Auditing Standards number 5 from the PCAOB website. I've just grouped the sections into smaller chunks and made video instruction blogs out of them so that it's easy to digest. So I want you to look at the table of contents and find the sections that are of interest or focus to you and watch those videos or read those blog sections to get an idea of what these sections mean without having to read the original literature itself. But along the video, you'll see the original literature so you can refer to it. Relationship of risk to the evidence to be obtained. This is just a complex way of saying the amount of support you need depends on how high your risk is. So paragraph 46, I've really just summarized it for you. As the risk increases, the evidence has to increase as well. So here, the note to 46 talks about the auditor has to get evidence about the relevant assertion, not necessarily test every control effectiveness. Meaning for a particular assertion, you may have 20 controls. You don't have to test all 20 of those controls to say that that relevant assertion is covered. You may pick 2 or 3 or any combination to give you that comfort. And the evidence varies. It can change based on what that assertion is. This is great news because that means we don't have to test every single control that's listed out there. And that's why we pick key controls versus secondary controls. Now, paragraph 47 talks about the factors that affect the risk associated with the control. And some of these you've already seen because we've done the risk assessment, the nature and materiality of the misstatement. Materiality just means how big is the amount. If the amount is going to be big, then that's a higher risk in terms of a misstatement. But as I mentioned, petty cash, if your petty cash was $200 off, $500 off, do you really care? Is that really material to your financial statements? The inherent risk. Inherent risk is really about the accounts. So people are more likely to take cash because it's fungible. It's just a fancy word to say cash can walk off and you could do stuff with it. People are not likely to steal prepaids. Who steals a prepaid when it's a prepaid insurance? All you're doing is amortizing the insurance over 12 months. So the risk for cash is inherently higher than the risk for prepaids. Then another factor to consider in risk is the volume or the nature of the transactions. So if you have millions of transactions, that has more risk than if you just have 10 transactions, 100 transactions. And then the nature of transactions. If you think about a software company where it's selling perpetual licenses and you have to determine VSOE and you have to do carve-outs, that's more complex than if you have a software company that sells software as a service, you pay a certain amount, and each month it's the same amount, $10.99, $20.99, whatever it is. The nature of that transaction is pretty homogeneous, consistent. There's not much judgment to it. Then there's also the effectiveness of the entity level controls and whether some of those entity level controls monitor other controls. What that means, really, an example is the budget to actual variance analysis. That's something that smaller companies often use as a key control because when you don't have a lot of people and the operations are fairly simple and the CEO or a CFO looking at the detailed budget to actual variances across different departments and organizations, it's detailed enough, done at a particular level that can give you comfort and reduce your risk. There's also the frequency of the control. So if a control you only have it once a year versus daily versus monthly, that also changes the risk profile. The more a control happens, the more likely that you can catch something or prevent something sooner than if you only did it periodically. Then there's a particular note here about information technology general controls, and that's why we integrate the financial, kind of the manual controls with ITGC. Another factor to consider in your risk is the competence of the personnel, the person who's doing it. Do they actually understand what they're doing? And sometimes that's a fuzzy, it's not hard and fast when you talk to someone. It's sort of your gut when you talk to them, and they can tell you the right answers to questions, or they say certain things that gives you comfort, versus other times it's hard to say, does this person really know what they're doing? Even if they described it to you, you don't know if they really get the meat of the issue. And then another point to it is automated controls generally lower the risk of versus a manual control. Because think about it, automated controls, a computer, a machine will do a sequence of steps exactly the same way. It doesn't get tired. It didn't go out late last night and can't read a particular report or transposed a number. So generally, automated controls have lower risk or higher reliance, and that's why we want to push as much as possible to automated controls. But that's only if ITGCs are also effective. And then there's a note here that talks about off-the-shelf software. So this literature has updated itself because in the early days of SOX, so many of the information technology systems, the ERP systems, were more complex, like an Oracle. And now we have so many applications that are SaaS or off the shelf where there's not much that you can change. It's just certain configurations. And here, this highlight is just talking about focus on the application controls that are built in the pre-packaged software. It's no longer customized, which is great. It's less work than the customized stuff from Oracle. And then finally, there's one of the risk factors is the significance of the judgments that has to be made. So going back to this, remember that a lot of the judgments, a lot of the big fraud or cases is mostly about management saying, do I want to reserve a higher or lower amount? And you can't really argue whether it's right or wrong. There's just varying degrees of support. And so again, judgment is key to this. And finally, the note here is that it's easier to say a control is not working than to say a control is working. So for some of our clients, it's sometimes easier to fail them because they're like, look, the evidence isn't there. You don't have to support that the control is not working. Paragraph 48 talks about deviations, that sometimes deviations will happen, and even though a deviation happens, it does not mean the control has failed. So let me give you an explanation between deviations and exceptions. A deviation example is normally there's a control that says the controller will review the AR reserve on a quarterly basis and looks at all the relevant reports, does the tie-outs, and signs off. Well, what happens if the controller went on vacation or is out sick or is on leave of absence for whatever reason? Well, now that control can be delegated to another person who's equally competent and can do the job. So maybe it's delegated to the VP Finance. Maybe it's been handed off temporarily to the CFO. That is a deviation from the normal process, but that doesn't mean the control is not effective. It may be even more effective because now a fresh set of eyes is looking at it, and maybe they're questioning things that the same person might not question. That's a deviation. Something is not exactly the way it's documented, but when you look at it, it's just logical sense, or it makes business sense that that would be the right replacement when all the parts aren't the same. An exception is the controller goes on vacation and no one reviews the AR reserve, and a staff accountant prepares the AR reserve, books the reserve, no one takes a look at it. That is a change in the process, and it's an exception because now you don't have a qualified person doing a review. And that's the difference between a deviation and exception. Paragraph 49 talks about, for each control, you can use different combinations of types of testing and timing to get sufficient evidence. And so an example is a walkthrough. If you do a walkthrough in combination of asking people, looking, watching them do something, inspecting the reports that they have, and reperforming the control, you might be in that sample then be able to say, I've now got sufficient evidence for that particular sample, that sample of 1, that it's operating effectively. So that's all 49 is saying, is you have to change the combination of the timing, the extent of testing, depending on the control. It's not all the same. Paragraph 50 talks about, well, what's the type of testing that you would do, and what's the order of evidence, that how much comfort does it give you? And so from the least comfort to the most comfort, and again, it's fairly intuitive, inquiry is asking. If you ask someone, that's the least supportive, because if I ask, did you do this control, and someone said yes, well, there's no proof other than their word for it. Observation is the next level that you can rely on. Observing someone doing it, that's better than asking them. You can see it. What's even better than that is inspecting the relevant documents. You can watch someone look at a report. But the better way is to watch them look at the report now, look at the report itself, and see what parts were they looking at in the report. Ask them which pages, which subtotals, what did you do? That's inspecting it. And then the one that gives the most support, the most comfort in terms of a control operating is reperforming the control. So in this case, you can ask the controller, did you do the AR reserve? And they'll say yes, and you can watch them look through the AR aging and do the calculation, and then you can grab the actual AR reserve and look at the various stuff. And then once you actually go through and do all the steps and you come out with the same result within, a reasonable amount, you reperform that control, you know for sure that this person has done it. There's a note here in paragraph 50 that says, asking alone, inquiry alone is not sufficient evidence to conclude that a control is effective. So inquiry is good for when you're documenting a process, but it's not enough when you're doing the test of effectiveness to call a control effective by asking someone. Paragraph 51 is yet another way to say, you've done all of this work, but now the documentation, the physical documentation or soft copy, the actual evidence of it, how much you keep depends on the degree of risk. So whatever testing you've done. Now, this is where you may do all of this testing. How much support do you save to have evidence that you've done that testing? The higher the risk, the more support you have to save. Again, fairly intuitive and logical. And the note here talks about, for smaller companies, sometimes they do all of these controls, but they may not keep all the formal documentation. So you just have to use your judgment and use a combination of testing techniques to get comfortable that a control is effective. But it's just recognizing, again, that smaller companies may not have the same level of documentation, formal documentation, that large companies may have. And now, paragraph 52 talks about the timing of test of controls. And I highlighted in two separate colors so that you can focus, because they're two separate thoughts. The first one is that the more testing you do over a longer period of time, that gives you more support and more comfort. And again, fairly logical. If you do testing of controls over a 9-month period, over a 12-month period, and throughout that 12 or 9 months, things continue to work well, that's more comfortable, more comfort for you than if you only tested 3 months. Could you say that during those 3 months, all of that continued to operate for the whole year? So again, very logical. The next part of it is when you're testing the controls, the closer you are to the management assertion date, which is basically the year-end date, the closer the testing is performed to the year-end date, the more support, the more comfort you have. So an example is if you did all of your test samples in first and second quarter, and they all passed, and you did no other testing, and you at December 31st had to say, are the controls working? That is less comfortable, less comfort than if you did testing for Q1, 2, 3, and some minor testing in Q4. The closer you get to the end of the year, the more comfortable you know that things haven't changed, that things are continuing to work as you did the testing in that period. Again, very logical, very intuitive. And paragraph 53 now talks about, well, none of our clients ever have static businesses. Things change all the time. And so paragraph 53 just talks about if the company implements changes to make things better, more efficient, or more effective, the later part of the year, if those controls were working, well, don't go and test the earlier periods when it may not be working or when it may not be as effective. And again, kind of no duh, yeah, test the controls that were implemented later, that were implemented to be more efficient or to be more effective. And paragraph 54 and 55 really talks about how much testing do you do, the extent of testing. And it just says the greater the risk, more extensively you have to test the control, and the greater the evidence you have to obtain and retain. 55 introduces the concept of a roll-forward procedure. And you'll often hear this. Roll-forward procedure is what we often do where we do a lot of testing in Q1, 2, and 3, and then the period for Q4 often is also called a stub period. Think of it, stub is just a little piece. During that, how do you make sure that all the testing that you've done in those 3 months period continues to work? How do you roll it forward? That remaining period, what do you do? And paragraph 56 just basically says what you do in that roll forward, in that stub period, really depends on the control. How long did the period last? Because sometimes some change, it's not just 3 months, is if it's 2 months, meaning we've tested everything up to November. Well, just the month of December left, that gives us more comfort. Versus we tested everything through August, and now we have to test September through December. Well, how much testing, how much changes happened in those last 4 months? Maybe our clients implemented a whole new ERP system that just went live for 2 months, just went live for 3 months. Well, there's more likelihood of changes. The risk goes up the closer the changes happen to the end of the year. So that's really talking about how much additional work do we have to do for that year, that period leading up to the year end. And in some cases, when the risk is low, that year-end stub period, you can really reduce the work. And here it's saying Inquire alone might be sufficient. Even though the literature says that, oftentimes the auditors, fourth quarter, they're not going to really rely on just inquiry. They're really going to inspect or do something a little higher than inquiry. So that's what we're talking about for risk and the evidence or the amount of work we have to do.